I want to touch upon another thing here. I'm sure you guys are seeing it. So there's a big redevelopment opportunity going on, I think, across the board. We're just kind of at the tip of the iceberg as far as post-pandemic. There's things in the news right now where shopping malls, the empty JCPenney and Sears are being kind of repurposed for Amazon distribution hubs. We have locally here shopping malls that there's one in particular, the Westside Pavilion, that's just got redeveloped into creative office, and Google signed a 7-year lease. So, I mean, these are kind of the bigger ones that make the headlines, but our users are, boots on the ground, seeing shopping strips being repurposed, small businesses. I mean, the owners are taking it on both ends, on the debt side or the loan side, that aren't necessarily working with them like they would and having flexibility, so they still got to make those lien payments. And then on the income side, the small businesses that are needing help, where you could keep deferring the payments, but how long can you survive off bridging that kind of deficit? So what we're seeing is a joint venture surge here locally, if that makes sense. So these family offices, multi-generational, multi-family family office, right? It's just a lot of families together. I've met a few that own quite a bit of property nationwide, and for the first time ever, they're considering a joint venture with the developer, because now they're going, well, what is the new highest and best use, right? A lot of their portfolio, the bottom laggards, are just, they're not making money, and they're scrambling to figure out what to do. So in that structure, obviously it's a joint venture, but it's a marriage, right? It's difficult. There's two parties, that one party has probably zero experience in development, and you're hoping to bring in someone that has much more experience, but it could be anywhere in between. So for you guys, what are some of the nuances that you've seen in that kind of joint venture, financial modeling wise, not legal, but just as far as like, okay, where is a template? Is there even a template? Do you guys first figure out what where they are, what they're trying to build, and who they are, and then maybe start that process? So if you could share some of that, would be really helpful as well.
Yeah, definitely. I think for starters, I mean, yeah, we have been involved in, a number of, litigation and disagreements between JV partners, right? And, when all the deals are going great, everyone's happy, everyone's making money, you don't see a lot of those issues, right? But, when things start to, kind of hit the fan and not be so well, then all of a sudden people are going back to the docs and, seeing what did we agree to? I don't remember that, but let's go back to the docs, right? And so I guess the overall, idea here is make sure that, because at the beginning of the deal, everyone's going to be on the same page, business, all the business terms are going to be negotiated, and you and your business relationship on the other side, right? So the developer and then the family office or private equity shop is bringing in the capital, everyone's gonna be happy and excited, and just make sure that it's papered correctly, right? Because, I think as Chris has said earlier, you go talk to the lawyers, right? And the lawyers, they interpret what you say, and so you have these finance people talking to the legal teams. The legal teams are putting them into the docs, and then the finance people are now 4 or 5 years later, opening, dusting off the docs and looking at it again and say, wait a minute, this doesn't look right. So just make sure that, you review the docs kind of right there. And, if there's any thing that you don't agree with, you get it settled then, right? And a lot of, kind of best practice would be to have sample calculations have an exhibit that has either a sample model or sample calculations, or spell it out, hey, you're going to use the X IRR formula in Excel, whatever version of Excel, and we're going to use actual days and things like that. Because, I mean, as an example, we talked to these one guys who like, oh yeah, it's a 9 IRR, right? Was the preferred return. And, you look at the docs and it's like, well, your attorney said it's a 9 preferred return over a 360-day year instead of a 365-day year. Okay. Which doesn't seem like that big of a deal, but that ended up being, $3 million swing between the two parties. Right. And that's just because, someone wasn't paying attention, maybe it was, who knows why, but that wasn't the intent of the agreements. But then a lot of times, we're coming in 4 or 5 years later, we get hired and it's like, well, that wasn't the business intent. And so it kind of just makes it really gray. So that's really, attach a sample model, have sample calculations, and understand, hey, when they say it's simple interest or compounded quarterly, understand what that means.
Mm-hmm. Yeah, the only thing I'd really add to that is Eric mentioned it earlier as well. Keep your docs simple. You can accomplish the same thing in 2 or 3 tiers that you could accomplish with 7 tiers. You can accomplish everything the same way in a much easier way than if you try to get creative to nickel and dime $1 more of promote.
Right.
Everyone's going to be happier. Everyone's happy when they're making money, but if you're not making money and then you have to dissect a massive agreement that has so much convoluted language in there that no one knows what's going on, you're gonna end up spending more in lawyer fees than you would have possibly ever made, by trying to be so creative with your wording. So to your point, it should be a marriage, it should be a partnership. And so don't try to nickel and dime through your waterfall. Just keep it simple. You'll get what you need. There's plenty of money to go around.
Yeah. And again, like be clear on the fees, right? Because a lot of times, one party is trying just to fee the deal to death, right? And they're going to get acquisition fees and disposition fees and financing fees, paid to them. And just make sure that you and your partners are all aware of everyone's fees and who's getting paid what, if the deal performs and if the deal doesn't perform. So yeah, and that's a kind of simple JV structure where just kind of 2 parties. Kind of the advice, if you bring in multiple investors, so let's say you go out and you raise money from high net worth investors, kind of the tip there is to make sure that everyone has the same deal structure. Okay, because a lot of times you'll go out and if you're the big investor will say, well, I want better terms than a small investor, and so they may get better, a lower management fee rate, right? Instead of a 1.5% management fee, they're only pay a 1.25% or 1% management fee rate. Or they may have a different preferred return hurdle. They may get a 9 pref instead of an 8 pref, or they may have different promote hurdles. And so especially for small shops or family offices, that makes the calculations infinitely more difficult, right? Because now all of a sudden you got people in different spots in the waterfalls, and some people are paying promote in different tiers, and it's going to cause confusion. And investors they're not going to get their pro rata share of distributions, right? If they know they're a 10% investor and they're only getting 9% of the distribution, they're going to be calling you and asking you, hey, what's up, right? And it may be right, that because of different terms and structures and agreements from other investors, right? They're not getting their 10% pro rata share, but try to keep it equal among all the parties. That's going to save you a ton of time and a ton of questions from your investors.
Makes sense.